Hey everyone, and welcome back. So legendary long-term investor Howard Marks has just released this week a brand new memo where he shares his thoughts on the economy and the state of the stock market and what we should expect as this pandemic is rolling on. So in today's video, I'm going to give a quick brief about who Howard Marks is, for those who don't know, and then we will jump into the memo and I'm going to talk about some of the key sections that I think are most important to understand as a retail investor, understanding what is happening with the pandemic at the moment and how you should be approaching the markets, approaching your stock portfolio. So with that said, if you do enjoy today's video, I would very much appreciate it if you could leave a like on the video and then let me know your thoughts down in the comment section below. And one other thing to mention, my little puppy, my dog, has been barking all day and very anxious or something. So she's in here at the moment. So if you hear any snuffling or barking or anything like that, then that's the source of that sound. So with that said, let's jump into a quick brief about who Howard Marks is for those who don't know who he is. Howard Marks is a long-term investor. He has a net worth of $2.1 billion, and he's most well known for co-founding the Oak Tree Capital Management Fund, which manages at the moment about $125 billion. And in terms of his investment philosophy that he uses in the funds, in the products available through Oak Tree Capital Management, the philosophy that he uses does differ in a substantial way, in a number of substantial ways, from the methods that we teach on the channel here. Here we are looking for unique opportunities in the stock market, and we're happy to sit on substantial amounts of cash while we patiently wait for those opportunities to appear. Whereas Howard Marks more has the approach of staying fully invested most of the time, but will move towards more defensive asset classes such as bonds, if the stock market and other higher risk assets are expensive. So he's more about being fully invested and just kind of changing the composition of his portfolio. But regardless of all of that, his memos that he releases quite regularly now are very, very valuable in understanding how financial markets and the broader economy function as a retail investor. So that's what we're going to get into in today's video. Now, the first important point that I took out of this memo was that he thinks that the pandemic, the crisis we're going through right now, is not a typical cycle. So for those who know Howard Marks, he is very big into identifying patterns in the markets. He has a book called Mastering the Market Cycles that I'm actually reading at the moment. It's a fantastic book. I'd encourage anyone to read it. But he is very much into looking at patterns in the market and how things happen repeatedly. And in that way, or not in that way, in fact, he believes that the current pandemic is not a typical cycle. So what is a typical cycle, right? Well, a typical cycle is that the stock market will go up due to businesses performing well. So when economic conditions are going well, as they were for the most part over the past 10 years, businesses are spending lots of money, they're innovating, individuals are spending money, they're reducing their savings because they feel comfortable in their jobs and they're making more money in their jobs as well. And then eventually that leads to over-optimism about the future. Businesses expect perfect conditions to last forever, and they start making riskier and riskier investments. They start to make less effective innovations over time. And on an individual basis, consumers take on more debt and their lifestyle expands beyond what they can afford. And then eventually that all catches up to businesses and individuals, and there is a correction. The cycle restarts as businesses fail, as individuals need to pay down their debts and start to save money once again. And the thing about normal cycles, a typical cycle, is that the downturn, the recession that comes at the end of that cycle is typically caused by some kind of economic problem. And as a result, the government and the Federal Reserve are able to use economic tools in order to fix that problem. But what we're facing right now is a pandemic where the problem, the downturn, the recession, all of that has been caused by something that is a non-economic factor. In this case, it's a virus. So you have this other factor in which economic tools can't fix, right? So they can use economic tools such as providing stimulus, lowering interest rates, printing money, and buying financial assets. They can do those things to prop up the economy, to improve it. But at the end of the day, what is sort of the root cause what is the root cause of this recession won't be fixed until there is a solution to the virus, right? They can keep spending money, but if they just stop spending money, if they stop providing stimulus, the virus will still exist. Businesses will still be operating at a limited capacity, and there will still be problems in the underlying economy. So in the meantime, while we're waiting for a vaccine or some other kind of solution for this virus, businesses are going to be suffering. A lot of businesses in a lot of places around the world are operating, as I said, at sort of limited capacity, whether that's a restaurant that can no longer sit as many people as they previously could. And then there's some industries where they're just completely shut down, right? You have areas like, well, not completely shut down, but for the most part, areas like travel, for example, a big part of a lot of different travel businesses are at limited capacity or completely shut down altogether. And that's going to be the case until the problem with the virus is fixed. And as I mentioned, stimulus and other economic tools can be used and are being used in order to sort of stem some of the bleeding in the economy, to kind of prop up the economy while we're trying to find a solution. But in terms of what's happening around that, there has never been more uncertainty around that economic stimulus, that economic relief. So earlier in the year, the US passed a significant stimulus bill that provided a lot of relief to businesses and individuals. But there hasn't been a significant stimulus bill passed for a very long time now, and a lot of businesses and individuals are feeling that. And there's just a lot of uncertainty around whether and when that stimulus package will come. The US are very, very close to an election, and it looks like there's not going to be a stimulus bill passed until after the election, which means that depending on whether a Democrat or a Republican becomes the president, that could have a significant impact on what that stimulus looks like for individuals and businesses. And then probably more importantly than that, whoever wins the House of Representatives and the Senate, the two houses in Congress, if they're both won by one party, then it might be very easy for them to pass stimulus right after the election. If one party has each, then it might be very challenging for stimulus to get through. So all of those things create a ton of uncertainty around the repair tools that are necessary right now to maintain the economy while we're waiting for a solution to the core problem, which is that virus. After that section, Howard Marks has a section that he calls the power of interest rates. And in this section, he is talking about the impacts that having 0% interest rates or near 0% interest rates in the US and around the world in many places, the impact that that has on financial markets and the economy. And some of the things that he lists here are things that we've spoken about before on this channel. If you've seen my Ray Dalio videos, then he is big on talking about how interest rates and the other economic levers function. And Howard Marks goes into talking about some of those factors, and he ends up listing a total of 7 different impacts that low interest rates have on the financial markets and the economy. And we're not going to discuss all of them because this video would go on forever, but I've handpicked a few that I think are really, really important and can teach a lot to the average investor. So the first impact that low interest rates have is that it has a stimulative impact on the real economy. And that makes perfect sense, right? Any purchase, whether it's personal or business, that requires a loan, lowering of the official fund rate at the Federal Reserve will, across the board, lower the rate to borrow money, whether that's you're borrowing money for a house, or you're borrowing money to buy a boat or an RV, or whether you're a business borrowing money to invest in innovation, to invest in the growth of that business. When interest rates come down, the interest expense on those loans goes down, and therefore the cost in order to get that money and make those investments or make those purchases goes down. The second impact is that it impacts asset valuation, so the price people are willing to pay for assets. And we've spoken about this a number of times on the channel, but investors look at investments in terms of opportunity cost. So they're looking at all of the potential investment opportunities, the risk and reward, and they're making a decision relative to other investment opportunities. And when the near risk-free rate offered by the US government is below 1%, I think at the moment it's about 0.7% to lock your money away with the US government in bonds. If you're earning 0.7%, and that's far below what you could have earned, a few years ago, then you are going to be willing to pay more for assets in other classes. So I guess another way to explain this is as as the risk-free alternative goes down, the return that investors are willing to accept in stocks, for example, or in property also goes down. And another way of saying that the return that you're willing to accept goes down is saying that you're willing to pay more for that asset, right? A stock is just a business that produces cash flow. Okay, if you pay more for that asset, if you pay more for that stock, then the relationship between how much you pay for that stock and the cash flows it delivers to you is worse. The return you're getting is worse, but you're willing to pay more for those assets and accept a lower return in stocks because your alternatives are also offering you very, very low returns. And a lot of people will argue that all assets are connected almost in kind of a line in terms of how safe those assets are. So of course, as you invest in higher risk assets, you would be demanding a higher return. It's why you demand a higher return on a stock than on a US government bond. Because if you put your money in the US government bond, you'll make 0.7%, which is terrible, but you will make 0.7%. They will not default on that. Whereas if you buy a stock, the business may or may not produce the profit that you're expecting out of it. And in this memo, Howard Marks uses a diagram of the capital market line as an example to show how this can change over time. So as the official fund rate, the rate that the Federal Reserve is charging to banks to borrow money, as that comes down, the returns of all other asset classes, even if they are riskier, comes down. And that means that asset prices are going up. And the kicker to all of this is that investors have this habit, for the most part, on average, of getting used to the returns that they were getting previously and kind of clinging on to those returns. And when interest rate or when the returns on stocks, for example, on average is going down, instead of investors just accepting that lower long-term return because of the environment that we're in, investors have the habit of seeking out riskier investments in order to achieve the same returns that they were getting previously with those safer investments. And obviously, in terms of reducing the risk in your portfolio, it makes a lot more sense just to accept the lower returns that we have in the environment that we have. But a lot of people give in to FOMO, they give in to the fear of missing out, and they move money into riskier and riskier asset classes. And that has a build-up effect over time. And that will slowly have an impact and build up, and eventually there will be a significant drawdown on those riskier assets, as even though the expected return for those riskier assets is higher, they're riskier in nature, and a lot of them will not pay on the interest that investors are expecting. Towards the end of the memo, he points out something that I think is really, really important to understand as an average investor. And it's another way in which the crisis we're facing now is very, very different to the typical crisis that we see in a broad economy. In almost every past crisis, the crisis has been exacerbated, made worse by panic of investors and individuals, right? You have investors who panic and they sell their stocks, which causes a significant sell down in the stock market and in other financial markets. And then you have individuals who panic and they cut their excess spending. They start to look at their savings account and start to protect their wealth a little bit more. And that has a flow-on effect to businesses that therefore generate less revenue and then can no longer have all of the employees they have. And those employees then are even more conservative on how much they're spending. So usually a crisis is made worse by a significant amount of panic by individuals. But in the current pandemic, in the current crisis we're seeing right now, the panic only lasted for a couple of weeks, right? Back in March, when everything was really unknown about this virus, the markets, at least in the stock markets, they fell almost 40% in just a few weeks. So just a few weeks of panic caused the market to almost lose half of its current value. But the different thing that happened in this crisis was that the stimulus came very, very quickly, right? You had the Federal Reserve, which quickly lowered interest rates to zero. They quickly started doing quantitative easing, so printing money and buying financial assets. And then you had the government, the US government, and many other governments around the world that provided significant stimulus to individuals and businesses. So the panic really didn't last for a significant length of time. You had individuals who felt a little bit better about their situation because the government was bailing them out a little bit. You had investors who were sitting there and looking and thinking, well, every other investment opportunity that's safer than stocks is offering me a basically 0% return. So they just all flooded back into the stock market because they don't want to miss out on the gains in the stock market. And obviously, people not panicking is not a bad thing at all, but something that you should be aware about is this virus is not gone. We don't have a vaccine for it. Many experts suggest that we might not even find a vaccine at all for it. So we have no horizon around when this pandemic is going to be over. And on top of that, in the US particularly, you have no idea when the next stimulus package is going to come, what it's going to look like. And all of those things added together mean that if there is no additional stimulus, then more businesses, as time goes on, will struggle. And that will cause more individuals to struggle as they lose their jobs. And if enough of these things build up again, we could see the panic that usually lasts a significant length of time, 12, 18 months in most crises. We could see that level of panic occur in this pandemic. Now, of course, it's entirely possible that we have a vaccine that passes stage 3 trials over the next couple of months and then can be manufactured and mass distributed across the world, within the next 12 months. And it's very possible that the US and other countries will pass more stimulus and provide more relief to individuals and businesses. And if that happens, we might not see the panic that we typically see for a long period of time in most crises, but a lot of things have to go right in order for there to be no panic over the next 12 months. And certainly, if there's a number of vaccines that fail their stage 3 trials, it looks like we don't have a vaccine for now 18 months or for 2 years down the road, and stimulus is not getting passed in the government, then there could be some panic that starts to build among individuals and businesses, and a lot of that could flow into the financial markets. He then goes on in the memo to talk about a number of other things, such as the implications of zero interest rates on wealth inequality and how that impacts the society and the financial markets. And he also goes on to talk about a couple of other topics that we will have to save for another day, or else this video will go on forever. But just like Ray Dalio's memos that he posts on LinkedIn, I highly recommend that you go check out all of Howard Marks' memos and read through them. And you don't have to take any action specifically in the market. It's not as if I'm saying, look, there's all this panic coming, it's time to sell all of your stocks and get on the sideline. It's more just about understanding what is happening now, how what is happening now is similar to times in the past, and how it is different. And just kind of becoming more aware of what is going on financially. And then from there, you can make better decisions in your portfolio over time. Oh, and speaking of Ray Dalio's LinkedIn, I'm also on LinkedIn. So I will leave a link in the description to my LinkedIn down there. So go check that out if you're interested. I've been posting some videos on there. So if you want another way to access some of my content and I guess be notified as well when I'm posting on YouTube, sometimes YouTube doesn't let you know. So if you want to have another place that you can access me, then feel free to use that link to check out that profile over there. Also check out my Instagram if you haven't already. A ton of you have been following my Instagram recently, so go check that out. But other than that, I hope you guys enjoyed today's video. I'd love to hear your thoughts on this memo and some of the things that we discussed today down in the comment section below. As always, I'll be down there answering questions and replying to comments as this video goes live. So if you race down there, you can have a discussion with me. But other than that, hope you guys have a great day, and I'll see you in the next video.